Most financial advice tells you to max out your TFSA first. But here's the thing. If you're a high earner trying to catch up on retirement savings and you have $5,000 available to save each month, you could actually get $8,500 working for you instead of just $5,000. I know that sounds too good to be true. But as a CPA, when I run these numbers, the math tells a completely different story than what you hear from most financial gurus. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. Here's the scenario I want you to walk through. Let's say you're earning $150,000 to $250,000 a year, and you're worried you're behind on retirement savings. You've heard the standard advice: max out your TFSA first because it grows tax-free. And that's not wrong advice. It's just not the optimized advice if you're in a high tax bracket. Here's why. Let's say you've already paid your taxes for the year and you've covered all your living expenses, mortgage, groceries, car payments, everything. And you have $5,000 left over each month that you could put towards retirement. If you put that same $5,000 into an RRSP and reinvest the tax refund, you can actually end up with $8,772 working for you instead of just $5,000. How? Because RRSP contributions generate immediate tax refunds. And if you're strategic about reinvesting those refunds, you create what I call the gross up effect. Most people treat the TFSA versus RRSP decision as choosing between two equal contribution amounts. But for high earners, the RRSP lets you amplify the capital you deploy. So let me show you what the numbers look like. These are hypothetical examples to illustrate the strategy. Your actual results will depend on your specific tax brackets, returns, and contribution timeline. Let's say you're in Ontario, earning $200,000 a year. Your combined marginal tax rate is approximately 41%, 29% federal, and 12% provincial. You've covered all your living expenses and you have $5,000 per month available to put towards retirement savings. Scenario 1, TFSA contribution. You have $5,000 per month available. You contribute $5,000 per month to your TFSA. That $5,000 grows at 7% annually. After 15 years, you have about $1.6 million. Straightforward. Now watch what happens with the RRSP gross up strategy. Scenario 2, RRSP contribution with refund reinvestment. You have the same $5,000 per month available. But instead of contributing $5,000, you contribute $8,500 per month to your RRSP. At a 41% tax rate, that $8,500 generates a refund of $3,485. You use that $3,485 refund to help fund next month's contribution. Your net out-of-pocket cost, $8,500 minus $3,485 equals $5,015, essentially the same as the TFSA scenario. The total capital working for you equals $8,500 per month. Here's the formula. With $5,000 available and a 41% tax rate, you can contribute $8,500 divided by 1 minus 0.41, which equals $8,475 by reinvesting the refund. I've rounded to $8,500 for simplicity. And because that full $8,500 is compounding at 7% in your RRSP, after 15 years, you have about $2.7 million, about 70% more than the TFSA scenario. Same $5,000 out of your pocket each month, but $8,500 in working capital for you instead of $5,000. This is a gross up strategy. You're using the tax refund to amplify your contribution capacity without changing your personal cash flow. Now, I know you're thinking, but Toyin, I'll pay tax when I withdraw from the RRSP in retirement. You're absolutely right. But here's the key insight. You will likely pay tax at a lower rate in retirement than you're saving at today. If you're earning $200,000 now and paying 41% marginal tax, but in retirement, you're drawing $80,000 to $100,000 a year from your RRSP, CPP, and OAS combined, your marginal tax rate withdrawals will probably be around 30%. That's an 11 percentage point tax arbitrage. You saved tax at 41%, but you paid back at around 30%. That difference is pure gain. And for catch-up savers, this matters even more. Let's say you're 45 and want to retire at 60 with $1.5 million saved. That's 15 years to build wealth. With the TFSA first approach, you're fighting uphill because of tax drag. With the RRSP gross-up strategy, the government is funding 41% of your contributions through refunds. Think of it this way. You're not just compounding your own money. You're compounding money the government gave you today, which you pay back later at a discount. That's the accelerator effect high earners have access to. But most never use it because they're told to max out the TFSA first. Here's how this plays out in practice. Let me walk you through a hypothetical example. Let's say Sarah is 48, earns $180,000, and has $150,000 already saved. She wants to retire at 62 with at least $1.2 million. After covering all her living expenses, Sarah determines she can afford to reduce her monthly take-home pay by $5,000 for retirement savings. That's her capacity. Her old plan: reduce her take-home by $5,000 per month. Transfer that $5,000 into her TFSA. That's $60,000 per year in actual contributions. Her new plan with the gross-up strategy: reduce her take-home by $5,000 per month. Same sacrifice, but contribute $8,500 per month to RRSP through payroll deductions. At her 41% marginal tax rate, the reduced tax withholding means her take-home only drops by $5,000. Total capital deployed is still $8,500 per month. By year 3, the compounding effect is powerful. She's built a system where her tax savings mean more capital is working for her. After 14 years, at age 62, Sarah has about $2.4 million in her RRSP from contributions alone. Her starting $150,000 has also grown to $387,000, giving her roughly $2.8 million total, well past her goal. Now, these are illustrative numbers assuming consistent 7% returns. But the principle is what matters here. For the same monthly sacrifice to her cash flow, she deployed 70% more capital by using payroll RRSP deductions instead of after-tax TFSA contributions. Now, this strategy works best if you avoid 3 common mistakes. Mistake 1: spending the refund instead of reinvesting it. The gross-up strategy only works if you treat your tax refund like it's already part of your retirement savings. If you spend it, you're doing a regular RRSP contribution, which is fine, but you're leaving money on the table. Mistake 2: using this strategy in a low tax bracket. If you're earning under $100,000, the TFSA first approach still makes more sense. This strategy is specifically powerful for people in the 40% plus tax brackets, where the refund is large enough to create that compounding loop. Mistake number 3: not adjusting withholding taxes. If you're contributing monthly to your RRSP, you may be able to adjust your payroll withholding taxes to get the refund throughout the year, not in one lump sum at tax time. Talk to your accountant or tax professional about whether filing a T123 form makes sense for your situation. This can smooth out your cash flow and make reinvestment more automatic. If you're a high earner trying to catch up on retirement savings, here's how to explore the strategy. Step 1: calculate your marginal tax rate. If you're in the 40% plus range, this strategy may be worth exploring. Step 2: determine your maximum RRSP contribution room. You can find this on your latest notice of assessment from CRA. If you have unused room from previous years, even better. You have more room to potentially deploy this strategy. Step 3. Consider setting up automatic monthly RRSP contributions. Consistency matters for any investment strategy. Monthly contributions can smooth out market volatility and make the math easier to track. Step 4. Plan to reinvest 100% of your tax refund. This is where the compounding loop happens. If you spend the refund, you're just doing a regular RRSP contribution, which is fine, but you're leaving potential growth on the table. Step 5, talk to a tax professional about adjusting your withholding. Optional but powerful. A T1213 form filed with CRA can reduce the taxes taken off your paycheck throughout the year, giving you access to the refund in real time. Your accountant can help you determine if this makes sense for your situation and ensures it's set up correctly. Before implementing this strategy, I'd recommend running your specific numbers with a financial planner or a CPA. We can look at your complete financial picture, your income, existing savings, retirement goals, and tax situation. Look, if you're a high earner in your 40s or 50s and you feel behind, you don't need to earn more or cut your lifestyle to the bone. You need to use the tax system strategically. The RRSP gross up strategy isn't about taking on more risk or making heroic sacrifices. It's about recognizing that when you're in a high tax bracket, the government is offering you a wealth building tool that most people never fully use. You're not cheating the system, you're using the system the way it was designed. If this was helpful, I'd love for you to subscribe. I'm here every week with strategies like this, specifically for Canadians who want to build wealth without the overwhelm. I'm Tony, and I'll see you in the next video.